Hi, I'm Jeff Lovell, a staff accountant with AA Accounting, and today we're going to talk about some special tax rules related to disposing of small business stock. Selling or otherwise getting rid of corporate stock will trigger a capital gain or capital loss, which is calculated as follows. We take what you get in exchange for the stock, minus what you originally paid for the stock, called your tax basis, and that gives us your gain or loss. Normally, any gain would be fully taxable on your tax return as income, and any loss would only be deductible up to a net amount of $3,000 per year. There are three special rules that change how the gain or loss is treated for tax purposes if the stock is qualified small business stock. The first rule allows you to deduct more of your loss. Under this special rule, shareholders can deduct up to $50,000 of the loss from disposing of the small business stock. If you're married filing jointly, you can deduct up to $100,000. Any excess amount over this is carried forward to a future year where it's subject to the normal $3,000 a year limit. To qualify, the stock has to be issued after November 7th of 1978, still be held by the original shareholder, who has to be an individual or partnership, and the corporation must be involved in a business, not in investing, during the 5 years prior to the stock sale. The second rule says that you only have to pay tax on half of the gain. This allows the shareholder to exclude half the gain from the sale of small business stock if it's issued after August 10th of 93 and is held for over 5 years. The exclusion is limited to 10 times your basis, or what you originally paid for it, and any excess is taxed at 28%. So, for example, let's have Sandy here. She sells her small business stock. There's a $100,000 capital gain. She pays the special 28% tax on half of it, or $50,000. The other $50,000 is tax-free. This results in an overall rate on the $100,000 gain of just 14%, which is likely less than the 15% or 20% capital gains rate she otherwise would be subject to. The last rule allows you to defer gain to the future. It allows you to avoid paying taxes if you exchange small business stock for other small business stock. There are a number of rules. You have to own the original stock for at least 6 months, and you have to buy the replacement stock within 60 days. To be qualified small business stock, it needs to be issued after August 9th of 1993. It has to still be held by the original purchaser. The corporation's assets have to be under $50 million. It has to actively be involved in a business, not in investing. And it can't be a hotel, restaurant, professional service firm, financial business, or a farm. If you have questions about the material I presented in this video, or if you have any other tax or accounting questions, why not call the tax experts at AA Accounting? We're here year-round to answer your questions. Call us today to set up an appointment to discuss your tax situation. We look forward to hearing from you.